Hi, and welcome to Macro Monday, where we talk macro and try to make sense of markets that they don't make any sense today at all in this special edition of Kingdom Under Siege. I love saying that. I'm your host, Steve Van Metre, and thanks for joining me today. Oh, yes, and of course we have a day where everyone is pointing out that Steve's an idiot, thesis is busted, inflation is finally coming, and the walls of the kingdom are going to crumble down. Well, not so fast at all. So in today's episode, we're going to look at the economic data and see what's going on in the U.S. services sector. We're also going to answer some questions on what is going on with the bond market. Because right now, we have the biggest bet against bonds in history. You want to look for reversals? Wait till one side is massively overcommitted, and you'll find out what happens going the other direction. And so we're going to look at that. So first, let's go hit the economic calendar. Oh, actually, you know what? Let's continue with this bond thing just for a minute. Remember, we had this triangle pattern, and people say, oh, technical analysis doesn't matter. Well, what happened is it broke down lower, and everyone piled on the short side. Sell, 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 sell. This is like the signal, because all of a sudden now it's like, this is it. Bonds are dead. No one's going to ever buy them again. Interest rates are going to infinity, and probably squared that and cube it on top of it. All because of what? What news? See, you can ask yourself, well, what was the news driving the markets today? Is it President Trump coming home from the hospital that's really driving inflation? No. It's news on stimulus hopes. Now, keep in mind, this year alone, we've had almost $2 trillion of quantitative easing, and we've already had a stimulus package, and it was how inflationary? Yeah, really not at all. And Obama did a stimulus package, and how inflationary was it? Yeah, well, there's another goose egg in the inflation camp. But all of a sudden, for whatever reason, people now believe that the next package will have to be stimulative because, okay, if the last one wasn't, and we had all this QE, and we all know for sure that really, those two together, is massively hyperinflationary, then this next one, this is it. This is the one that now all of a sudden, 26.5 million Americans who are on unemployment are going to get their stimulus checks, run down to the bank and get loans, which they're not because the banks won't lend to them because they don't have a job, and they're going to run out and buy discretionary goods and services, preferably from foreign trading partners, and all of a sudden stimulus is going to rocket higher. Yeah, okay, sure, not going to happen. You know, stimulus can be inflationary in the short term, but over the long term, because it is borrowed money, it is deflationary. But yet the markets are locked in on this deal. Now let's take a look at the economic data and see what's going on over here. So we've got the market, MARKIT Services PMI day. We also have the quote unquote official ISM non-manufacturing or Services PMI. Now let's look at the ISM first, because it really, to me, doesn't paint the correct story of what's going on in the market, and it's completely based on how they calculate it. And we go back to earlier this year, and you see in January, we see expansion, slight expansion in February, better than slight expansion in March, very slight expansion in April, and then in May, as everything is shutting down, we get a contraction, but on the low side of contraction. And then in May, a mild contraction, slight contraction. And then in June, boom, we're now back into above average or above slightly expansion. And then in July, we're almost into full expansion mode. In August, we're definitely strong on the slight expansion side. In October, we're strong on the slight expansion side, which tells us that based on the ISM and these expansionary prints over the last 4 months, that the services sector now is better than it was before the pandemic. We know that's not true. I mean, it's clearly not true at all. Now, if we go over to the to market, who does their own version of this, see a different story, because now coming into the year in February, we see February there was slight expansion. March, no change. And we move into, March was a slight contraction, a little bit better than slight, but on the higher side of slight. In April, we have in May, we have a massive destruction in the services sector. Economy is now shut down. This thing is bad, a massive hole now. And then in May, it gets even worse. Not as bad, but the hole gets dug even deeper. And then going into June, So the hole gets dug even a little bit more deeper. And then by July, no change. August, slight expansion off the bottom of that hole. Slight. And then September, slight expansion above that. According to market, there's no recovery in the services sector. So you get these really polar different views between the ISM and market. And clearly, the ISM is using different things in its formula to calculate and showing expansion, whereas market is, I think, giving a much better pulse of the services sector. All right, so let's go back to, this massive bet against bonds, because in the market, when you have everybody, tilted on one side, kind of think of it as a teeter-totter, everyone's, piled into one side, where do you think the markets go next? Well, they go the other direction. And I know a lot of people think, oh man, you're just panicking, you're, an idiot, your thesis is busted, and blah, 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 blah. No, when I say I am bullish bonds, it means I don't sell the dips. I don't care. I'm not worried about it because I know how my thesis is going to play out. I know interest rates end in the bottom line is interest rates will end up much lower than they are today, probably near zero. So a bump in the road doesn't actually bother me, because when you look at what's going on and how hedge funds are positioned, this is what I saw Saturday, and we see in the 10-year, hedge funds increase their bets that 10-year bonds are going to go up in price. So hedge funds are long intermediate term bonds. But look at what's going on in the 30-year bonds. Up here this last, month and a half, you had the largest short position in the 30-year bond, meaning the largest bet against 30-year bond. All these bets are saying the bond price is going to go down on the 30-year and interest rates on the 30-year are going to go up. And then they went from 150,000 contracts to 208,000 contracts. Boom, now they're at the largest short position. Now these, again, speculative short position. Now there is an equal and opposite side to this. So for every short position, there has to be a long position. You have to have a balanced bet on the futures market. And who is long the bond market? The commercial hedgers or the smart money, your large commercial banks, are all betting on higher bond prices. Now, isn't that interesting? And Zero Hedge put this out today, and they looked at both the leverage funds and speculators, and they have the largest record short position combined in the history of the 30-year bond market. So everybody has crammed in on this higher interest rate trade. The entire bond market, you got all the speculative selling, all these big bets, and people say, well, Steve, what's going to happen when people start selling bonds? They've been selling bonds. And that's the whole point, because if we go over here back and look at where the 30-year closed today, probably closed, 1.587. So now let's go back to my charts, because unfortunately my charting platform does not close out the bond market. So what do we get? 1.587. So somewhere right up in here it got to. So what you mean to tell me is we have the largest speculative short position in the history of the 30-year bond market. And the best we can get is from 1.4, and we can't even get to 1.6? And everyone says that's what's going to catapult yields higher? No, what this is telling you is that people are now so deep into their short positions, they're overcommitted. And so when I look at this whole picture, and people say, the kingdom's going to fall apart. Oh, no, not even close. What it's telling you is how resilient the bond market is, because when you have everybody throwing stimulus rocks at you, right? The kingdom under siege, and the walls are still standing because they could only get from roughly 1.4 to not even 1.6. And where do you go from here when you're overcommitted in your hand? See, people think that quantitative easing is stimulative. It's not. In fact, I forgot to announce, because I had to re-record this because I didn't have all the stuff lined up. Do you want to know who today's big guest is? Jeff Snyder of Alhambra Investments. I know. It was great. 90 minutes of Jeff. And man, we dug deep into all the things that you had questions about over several weeks. We dug into the bond market, what's going on, stimulus, monetary policy. And what is the overall conclusion? Interest rates are headed, lower, because you can't get out of this trap. So the good news is, for those of you who are Real Vision subscribers, the show will allegedly be released on Wednesday. Don't have the final confirmation on that. And then we were promised a short while later that it will be aired here on this channel for free. Again, 90 minutes of Jeff Snyder, like pretty much the smartest guy out there in the monetary space, just for you. And I'm really excited about it. But all it does, all that interview, told me, is the system is broken. And when you have all these people sitting on one side of that teeter-totter, I mean, remember, everybody is piled in, right? Like this. And they're over here saying, aha, we got you. Right. Whenever markets are unbalanced, they tend to go the other direction. Believe me, Kingdom's been under siege a lot. I mean, it's normal. When you're a bond bull and you're wearing this crown, this is very, very normal. And it doesn't really faze me because there's been far worse situations the Kingdom has been in. And you can see going back, at least over the last 2 years, if we go back down here, the TLT, it's been down here, it's been down here, it's been all over the place. And so right now, remember, this is where the defense is the Bears. Here's the offense, the Bulls. And we got across the 50-yard line, and they are cheering as if they've won the game. Not even close. Not even close. So does this bother me at all? Nope, not really. We saw decent volume on the market there. Remember in the chart show, for those of you who watched that, I said the equity market needed to get over the 50-day moving average. It indeed did that. And it did it on, fairly low volume, which is pretty interesting. So not many people wanting to sell today. Let's take a look at the dollar. Because remember, I said the dollar was likely to head down. And I said, don't be surprised if it gets down here to this, 93 level. And it went down. That's providing some boost for equities. But again, the whole view right now is bonds are dead. And really the real story to all this, what I think is cool is you've got everybody betting against it. And when everybody bets against something, they're usually wrong. I'm Steve Van Metre. Appreciate taking the time to watch. Even if you're not a bond bull, you can still subscribe because my wife made these cool things on sticks and you like them, I like them. So with that, I will see you on Wednesday and we'll see if there was a big reversal in the bond market by then. I have a hunch. Well, there probably will be. And with that, since I'm not on the right screen here at all, I'll get you your disclosure in a second. There we go. The content of this video is provided as educational information only, is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or participate in any particular trading strategy. This video is prepared by Steven Van Metre, personally past business expressed this video that do not reflect the view, Atlas Financial Advising, or Steven Van Metre Financial.